for helping us understand. Allow me to welcome Mlamuli Mbambo, an award-winning author. Oh, hey, you guys, the people they bring here. Mlamuli is going to tell us about interest rates and how, who is responsible for them, and actually why they are moving up and down the way they are doing. I want to hear about this.
Thank you so much, Lerato, and hello everyone. Hello learners. My name is Mlamuli Mbambo. I'm the best-selling author of this book called Winning the Money Game, A Guide to Financial Well-Being. So today I'm here to discuss interest rates and who's responsible for them. So essentially, interest rates are the cost of money, and it has two different parts. The one side of interest rate is where you have extra money and you actually deposit money in a bank or you borrow it to a friend. You earn interest from this money because you are actually sacrificing not using it now so that you can actually charge the other person or the bank for using your money. So for example, let's say you have 10 cows and you borrow your neighbor 1 cow for a year. After a year, your neighbor would bring back your cow plus a calf. In this case, the calf would be seen to be the interest that you received for lending the neighbor your cow. And the more commonly known interest rate is where you borrow money, usually at a bank, and you're charged interest for borrowing that money. In this scenario, interest is the fee you are charged for borrowing the money. Interest is the cost of getting that money because you have not essentially earned it yet. So for example, back to the farm, and let's say now you the one who needed the cow. You might ask your neighbor or induna of the area to borrow you a cow for, let's say, a year. After that year that you borrowed the cow has birthed 2 calves. And you would then bring back the cow, which is called the principal or the initial amount of money that you borrowed. Plus, you would bring them the calf as the interest payment on the cow that you borrowed. And the nice thing is here, you would see that you would then keep the other calf and raise it to be a cow, which would help you build up your own livestock or your own herd. And in a similar manner, banks borrow money from the South African Reserve Bank. The South African Reserve Bank charges commercial banks like Absa what is called a repo rate. In banking, this essentially means a repurchase agreement or a repurchase option. When there is shortage of funds, so let's say Absa wants to borrow out more money than it currently has, it will actually go to the South African Reserve Bank and borrow from there based on the repo rate. And the South African Reserve Bank uses this monetary policy to decrease or increase the amount of money banks have in order to lend to the South African population.